Hi, this is Sudhakar Shanbag. I manage investments at Kotak Life Insurance. We are here to discuss the Union Budget 2017. The government over the last 3 years has focused on largely 3 areas: tax compliance, rural and agricultural part of the economy, and growth with job creation. This budget is a continuation of actions in these areas. It's a non-disruptive, pragmatic budget in a challenging global environment, while domestic macros look really good. There has been focus on economics and growth, unlike populism, which was expected because of the upcoming elections. The finance minister has stuck to the path of fiscal prudence with a fiscal deficit of 3.2 while supporting growth through higher capital spending. There is a focus on infrastructure, rural economy and irrigation, which will have impacts on inflation and growth going forward. Impetus has been provided to 3 focus areas: digital, financial inclusion and tax reforms. The process of transparency in political funding shows the intent and direction of the government. The impact of all this is going to be a stronger balance sheet of the country, playing to 2 themes, which is movement from physical savings to financial savings and the informal part of the economy moving to the formal economy. India is and is expected to remain one of the fastest growing economies in the world.
Hi, I am Hemant Kanawala, Head of Equity at Kotak Life. I would like to talk about the impact of budget proposals on equity markets. Stability in taxation rate was a major positive in the budget. There were no major changes in direct taxation, with benefits given to lower income people. With implementation of GST, changes in indirect taxes will be less relevant going forward. FII concern on taxation arising from indirect transfer of shares have been addressed. The second point, focus on rural and agriculture sector will help the consumption side, while focus on infrastructure sector will help the investment side of the economy. Benefits given to affordable housing sector will help generate jobs and create demand for building materials. Adherence to fiscal consolidation will ensure stability in macroeconomic variables like current account deficit and inflation, which will help sustain growth above 7% in the medium term. The fourth one, the reforms. Budget has ensured that momentum on economic reforms is sustained. Abolition of FIBP and listing of public sector enterprises is announced. GST implementation from July 1 to be an important event. So what does all this mean for the earnings outlook? No material changes in earnings expectation for FY18. High-teen growth in earnings possible on the back of pickup in the economy and improvement in asset quality. We believe domestic institutions to continue receiving funds as budget gives further push to financial savings and equity penetration is still low in India. FI flows is likely to pick up as Indian economy is well placed compared to other emerging markets. So what is our outlook on the equity markets? We believe India offers a great opportunity for investors to invest in equities with 3 to 5 years outlook on the back of improvement in the Indian economy.
Hi, I am Kunal Shah, Head of Debt here at Kotak Life. I will talk about the implications of budget proposals on debt markets. Government continues to march on fiscal consolidation roadmap as recommended by FRBM panel by targeting fiscal deficit at 3.2% for 2018. The focus continues to be on ensuring macroeconomic stability amid volatile global environment. 3% of fiscal deficit target from 2019 onwards and a 60% target for debt to GDP will ensure macroeconomic stability in the longer run. Low debt will also ensure rating upgrades by international agencies. Lower fiscal deficit and higher capex will ensure low and stable inflation and higher real GDP growth in medium term. Gross market borrowings at 5.85 lakh crores is on expected lines and should ensure stable bond yields. Lower fiscal deficit will pave the way for persistence of accommodative monetary policy stance. RBI might reduce by 25 to 50 basis points if inflation remains below 5%. Bond yields will remain in the range of 6/4 to 6/2. Fiscal year 2018 will be a year of accrual income with some possibilities of price appreciations. Prudent fiscal management and lesser cash transactions can pave the way for lower and stable inflation and hence stable rates and higher growth.
Put all this together means growth with lower inflation, which augurs well for both equity and debt markets, and hence staying invested in these financial asset classes is recommended for medium to long term based on your risk appetite.